The 11-minute massacre, how Wall Street murdered silver. There's a moment that happens in every market collapse when you realize the game was never fair. For 340,000 people, that moment came at exactly 9:42 a.m. on January 7th. They watched their life savings disappear, not over months, not over weeks, in 11 minutes. What I'm about to tell you isn't a theory. This happened yesterday morning. And the evidence is so damning, so precise, that even the people who orchestrated it can't hide what they did. Let me take you back 18 months, because to understand how the greatest robbery in financial history unfolded in 11 minutes, you need to understand the trap that took a year and a half to build. March 2024, silver is climbing. $30 becomes 40, 40 becomes 50, then 65. JP Morgan Chase, the largest bank in America, is bleeding. They're short 6.2 billion ounces of silver. They bet the price would fall. Instead, it's exploding. The margin calls start coming. The Federal Reserve opens emergency lending windows. The clearing houses are panicking. For 3 months, JP Morgan scrambles to cover their position. They buy back everything they sold. By May, they're out. The short position is closed. The silver community celebrates. Finally, the manipulation is over. The shorts surrendered. We won. But that's not what happened. What happened next was patient, methodical, evil in its brilliance. Because JP Morgan didn't just walk away. Starting in June 2024, they began buying. Not small positions, not cautious hedges. They built the largest commodity position in human history. 4.2 billion ounces over 18 months. They bought futures, they bought physical metal, they bought call options, they bought everything. And they did it so carefully that nobody noticed it was all coming from one source. The market saw rising prices and thought it was natural demand. Industrial users scrambling for supply. Retail investors finally waking up to inflation. The supply deficit becoming real. But 70% of the buying pressure was JP Morgan. 70%. By December 2025, silver hits $95. The mining stocks are at all-time highs. YouTube is flooded with predictions of $200 silver. Coin dealers are sold out for weeks. Premiums are $50 over spot price. Everyone thinks they're about to get rich. And JP Morgan, sitting on 4.2 billion ounces purchased at an average of $73, watching the price hit 97 in early January, knows exactly what comes next. January 7th, 2026, 9:31 a.m. Eastern Time. A sell order appears in the COMEX silver pit. 283,000 contracts, 1.4 billion ounces. The desk identifier reads JPM CMDTY07. JP Morgan's Precious Metals Division. The order type, market sell, immediate or cancel. Translation, dump it all right now at any price. Silver is trading at 97.15. 2 seconds after the order hits, executions start printing. Within 26 seconds, the price is 91.20. $5.95 gone in half a minute. The selling doesn't stop. 87.50, 84.10. 2 minutes and 6 seconds later, all 1.4 billion ounces are gone. Average execution price, 89.32. The market is reeling, down nearly $13, but there's no pause, no breath. 9:34 a.m., second order. 341,000 contracts, 1.7 billion ounces, same desk, same order type. Sell everything now. The price at that moment, 84.10. 35 seconds later, 79.30, then 73.80, then 67.50. 3 minutes and 19 seconds to execute. Average price, 72.18. The market has lost nearly $30 from the opening. Margin calls are triggering across every retail brokerage platform in America. Accounts are being liquidated automatically. Positions sold at whatever bid exists. Panic is setting in, but JP Morgan isn't done. 9:39 a.m. The final order, 423,000 contracts, 2.1 billion ounces. And this is where something breaks inside the market, because by now there are no bids left. Everyone who was buying at 90 is gone. Everyone at 80 is gone. The order book is a wasteland. 58.20, 47.90, 38.40, 33.10. At 9:42 and 6 seconds, the last execution prints at 31.40, 68% down from the opening price in 11 minutes. 5.2 billion ounces sold, weighted average price, 64.81. Let that settle in your mind. JP Morgan bought at 73. They just sold at 64.81. They lost $8.19 per ounce on 4.2 billion ounces. $34 billion in losses. Why would the most sophisticated bank in the world intentionally lose $34 billion? Because the silver liquidation wasn't the trade. It was the detonator. 3 days before the crash, January 4th, JP Morgan's equity derivatives desk spent $12 billion on call options, S&P 500, NASDAQ, at the money strikes, expiration January 10th. They were betting that within 1 week the stock market would surge. When silver collapsed 68% in 11 minutes, something predictable happened. The market interpreted it as the death of inflation. If silver, the ultimate inflation hedge, just crashed that violently, inflation must be over. The Fed must have won. It's safe to buy stocks again. By 10:15 a.m., the S&P 500 was up 2.8%. By noon, 3.9%. By the close, 4.2%. The NASDAQ gained 5.1%, the largest single-day rally since November 2023. JP Morgan's $12 billion in call options, now worth $43 billion, $31 billion in profit in 1 day. Add the numbers. Lost $34 billion on silver, made $31 billion on stocks. Net loss, $3 billion. But we're not done counting. During the crash, JP Morgan didn't just sell what they owned. The trade logs show 5.2 billion ounces sold. That extra billion ounces, those were naked shorts. Positions they didn't have. They shorted at an average of $53 during the collapse. Then 2 hours later, when silver was trying to stabilize at 31, they covered, bought back 1 billion ounces at 34. $19 profit per ounce, $19 billion. Now we're at net positive $16 billion. But there's more. Over the 18 months JP Morgan was accumulating silver, they were simultaneously selling call options to retail traders. Every time silver rallied, people bought calls betting on $100, $120, $150 silver. JP Morgan sold them those calls, 840,000 contracts, $17 billion in premiums collected. When silver crashed to 31, every single call expired worthless. JP Morgan kept all $17 billion. Running total, $33 billion in profit, and we're still not finished. Because when silver fell from 97 to 60 in the first 8 minutes, every leveraged retail position got a margin call. Most couldn't post cash fast enough. Their positions were auto-liquidated, sold at market prices, which means sold to JP Morgan's buy orders. Retail bought at 80, 90, 95. They got liquidated at 35, 32, 31. JP Morgan bought that inventory at 34, then resold it an hour later at 42 as the market tried to bounce. 47 hedge funds faced the same fate. Over-leveraged long positions. Margin calls they couldn't meet. Prime brokers forcing liquidation. A cascade. JP Morgan waiting at the bottom with infinite capital. Estimated profit from liquidation arbitrage, $11 billion. New total, $44 billion. One final piece. When silver crashed and stocks surged, the bond market sold off. Treasury yields jumped from 4.18 to 4.43, 25 basis points in 1 day. JP Morgan's interest rate swap desk had $80 billion notional in positions, betting rates would rise. $3 billion more in profit. Grand total, $47 billion. The largest single-day profit from a coordinated trade in financial history. But you have to understand something. JP Morgan didn't do this alone. They couldn't have. January 4th, 3 days before the crash. A meeting takes place at the Federal Reserve Bank of New York, not on any calendar, held in a SIF, a classified facility used for national security discussions. Jerome Powell, Janet Yellen, Jamie Dimon. 3 officials from the National Security Council, 4 hours behind closed doors. The topic, according to someone who was there, how to neutralize silver before it destabilizes the dollar. By early January, silver at 97 wasn't just expensive, it was becoming a geopolitical threat. China was accumulating. Russia was accumulating. BRICS nations treating silver as an alternative to the dollar, a hard asset that can't be printed, a foundation for a post-dollar monetary system. The Federal Reserve looked at this and saw an existential threat. If silver went to 120, 150, 200, it would validate the narrative that the dollar is dying. It would accelerate de-dollarization. Undermine American monetary authority. They needed silver dead. But the Fed can't directly intervene in commodity markets. They needed a proxy. A bank with the capital and moral flexibility to execute the operation. According to the source, Powell's request was explicit. Crash silver. Whatever means necessary. We'll provide regulatory cover. No enforcement actions. This is national security. Dimon's response, we can do it. But we need 3 days to position. And we need your commitment that no one investigates. Powell agreed. No documents. No emails. just a verbal understanding that silver would be destroyed to protect the dollar. 3 days later, it happened exactly as planned. And there's technical proof of the collusion. COMEX has circuit breakers. If silver moves more than 5% in 5 minutes, trading halts automatically for 15 minutes. It's designed to prevent exactly what happened. At 9:33 a.m., silver was down 12%. The circuit breaker should have triggered. It didn't at 9:37, down 30%. Should have triggered, didn't at 9:40, down 60%. Absolutely should have triggered, nothing. Trading continued until 9:42 when silver had fallen 68%. Only then did the breaker activate. The COMEX's official explanation, technical malfunction due to unprecedented conditions. That's a lie. Sources inside the exchange confirm the circuit breakers were manually overridden by risk management, acting on verbal instructions from senior regulatory authorities. Translation: the Federal Reserve told the exchange to disable the safety mechanisms so JP Morgan could complete the liquidation without interruption. If the breakers had worked, if trading had halted at 9:33 when silver was down 12%, the crash would have been contained. Other buyers would have entered, the market would have stabilized. But with the breakers disabled, JP Morgan had a clear runway to dump 5.2 billion ounces uninterrupted. Let me show you who paid for this, because these aren't abstract numbers. These are lives destroyed. 340,000 retail accounts held silver futures on January 6th. Average position, 12 contracts per account. Average value at $97, 580,000. When silver hit 31, the average account lost $410,000. Multiply that across 340,000 people. 139 billion in retail wealth gone. Most of these were margin accounts. Borrowed money amplifying the bet. When the crash came, they got liquidated. No chance to save themselves. Everything gone in the time it takes to drink a cup of coffee, retirement savings, college funds, money people spent years building, vanished. 47 hedge funds lost 74 billion. Millennium Precious Metals managed 11 billion. 93% allocated to silver, lost 9.4 billion. 85% of the fund, now in liquidation. Investors will get maybe 10 cents on the dollar. The SLV Silver ETF fell 82%. 11 million retail investors held it in retirement accounts. 47 billion in retirement wealth destroyed. Mining stocks collapsed 90+%. Pan American Silver from $87 to $7. First Majestic from $34 to $290. 240 billion in market cap evaporated. Mines closing. Thousands of jobs lost. Total wealth destroyed. $500 billion. Transferred from ordinary investors to JP Morgan and short-term equity traders who rode the stock market surge. This wasn't a market event, it was a wealth transfer. The financial system cannibalizing outsiders to protect insiders. And here's why they were so desperate to do it. In late December, U.S. intelligence intercepted communications from the People's Bank of China. China was preparing a massive silver purchase. $500 billion, 6 billion ounces to be bought in January 2026. The goal, corner the silver market. Create a shortage so severe that Western manufacturers would have to pay whatever China demanded. Economic warfare using silver as the weapon. If China had executed that purchase, silver would have hit $2, $3, $500. The supply shock would have crippled Western electronics, solar panels, defense systems. Everything requiring silver would face shortages. China would control the entire Western industrial base. The Federal Reserve was briefed in late December. They panicked. If silver went to 300, it would validate the narrative that hard assets are superior to fiat currency. It would accelerate de-dollarization. Countries would dump dollars to buy commodities. The dollar's reserve status would be threatened. So they made a decision. Preemptively crash silver before China could buy. Make it so violent, so dangerous that even China would be afraid to enter. It worked. According to latest intelligence, China has put the operation on hold. They're not buying. They're watching. Trying to understand if the market is safe. The Fed achieved their objective. They killed the Chinese purchase before it happened, saved the dollar, but they destroyed $500 billion in investor wealth to do it. And they don't care, because to the Federal Reserve, protecting the dollar justifies any cost, even if that cost is paid by ordinary people who believed in free markets. So what does this mean now? What's the lesson when you know the government can crash any market 68% in 11 minutes whenever it threatens their interests? Silver as an investment is dead, not because of supply and demand, because the government proved they'll destroy it whenever necessary. You can't build wealth in a market where the rules vanish when you're winning. Silver might bounce to 40, 45 over coming weeks. Technical traders will try to buy the dip, But everyone now knows that if it approaches 90 or 100 again, this will happen again. The playbook is exposed. The game is rigged. The only winning move is not to play. If you're still holding silver, exit. Take whatever you can get and move your capital to assets the government doesn't consider threats to the dollar. Stocks, bonds, real estate, anything priced in dollars that supports the dollar system. Because betting against the dollar just got 340,000 people obliterated, and the government isn't even hiding it anymore. They'll crash silver whenever they want. They'll use JP Morgan or another proxy. They'll disable circuit breakers. They'll authorize insider trading. They'll do whatever it takes with complete impunity, because protecting the dollar is national security, and national security justifies any crime. That's the lesson of January 7th. That's what JP Morgan's $47 billion profit teaches us. The system isn't broken. It's working exactly as designed, to protect the powerful, to destroy outsiders, to maintain dollar hegemony at any cost.